with CAC Specialty. I'm pleased to introduce our next presenting company, Talos Energy, and its founder, president, and CEO, Tim Duncan. Talos is a leading offshore energy company focused on exploration and production activities in the offshore Gulf of Mexico.
Okay, thanks. My name is Tim Duncan. I'm CEO of Talos Energy. It's been a year and a half since I've been up here, and I have breaking news in that this suit fits. And so I'm pretty happy about that. I was actually pretty nervous on the plane last night when I thought about packing it. But look, we have a lot to talk about, and a lot of what we're going to talk about in the opening remarks about, where do energy companies go? How do we think about energy companies going forward? And we're going to talk a little bit about that in our slides. I look back at this particular conference, actually, and hopefully I'm hitting the right button. There we go. So I look at this particular conference. We built and started Talos in 2012, and then we went public in 2018. First time we attended this conference as a public company, I think they had to grab some employees and volunteers and said, can you just sit in there? This guy just got public. We don't want to make him feel bad, which I totally understand. Then in 2019, a year later, we had standing room only. We were actually the top performing E&P stock in the entire sector, and we're very proud of that. Then we go into 2020, just finished a transaction, and I'll be darned, COVID hit. And we looked at where we were as a firm, and we had a nice leverage ratio. I think going into the pandemic, we were about a 1.3 debt to EBITDA ratio. So we knew we were going to make it. I think the question was going to be, what were we going to do when we got out? What was it going to look like? And so to us, what we were hearing about, and how could it all fit relative to our strategy? You were hearing about certainly the transition. You were hearing about wanting a low carbon economy. You were thinking about emissions focus. All those things many of us in the room were already thinking about. Put on top of that, you were hearing about the majors and the IOCs and the NOCs talking about monetizing their portfolio. So we had to think to ourselves, how do we evolve in this current space? And part of that evolution was, let's do what we do well, and let's be the developers and the second owners of these assets in conventional offshore basins. Let's expand the footprint of how we do that, because these assets are going to come to the market, and someone needs to be the owners of these assets that are responsible, can lower the emissions, and frankly, the world still needs these assets to carry on and to do well. But what else can we do with the skill set we have, which is conventional geology, which is project management, which is logistics in an offshore and inland water environment? And we looked at wind, and we haven't given up on that, but we looked at CCS and said, we can play there. And there's an area where we can evolve from just being an oil and gas company to being an energy solutions company. We'll talk about a JV we have with a UK firm called Starega and the efforts that we have on the CCS side. And so what you're going to see from us, and when you think about on these slides that aren't on the screen, there we go. In the future, let's go back one, is you're going to see evolving into what was a private company just in the Gulf of Mexico to a public company, U.S. Gulf of Mexico, offshore Mexico, big discovery, to potentially a Gulf of Mexico international E&P company with a low carbon focus on the CCS side of the business. So quick snapshot of our assets. Again, the CCS joint venture I just talked about. It's focused on the Gulf Coast. I'm going to spend some time with that later. You can see our acreage footprint. We have over 1.3 million acres offshore in the Gulf of Mexico. You can also see the seismic footprint. That's important for our strategy. Second quarter, we were over 66,000 barrels equivalent a day, very liquids weighted, good leverage ratio. We'll talk about that in a minute. You see our core infrastructure. Again, our strategy is buying these assets from big companies, taking that fixed cost, reprocessing seismic, reinvesting in a drilling program, and then driving up margins with new barrels that go into an already fixed cost structure, getting better break-evens, good rate of returns. We're going to expand that into other areas as we go forward. This is a slide that, if it weren't for the pandemic and that extra drink we all got used to having, I'd throw in another one with this slide. So what you're showing here is our mid-year reserves. You can see the PDP, the total value of 1P. You can see the PDP breakdown value on the left. Take away, some ARO, take away some debt, take away some hedge liabilities, take away multiple years of G&A, and you're still somewhere around $30 a share trading at 11. So, it's frustrating for us. Obviously, we think that we rate out fairly cheap relative to the portfolio we have and the opportunities we have in front of us. But it speaks to a choppy market, and it certainly speaks to needing to be back in these conferences, getting on the road, doing these one-on-ones, and being in front of you guys. Now, this is pretty interesting. I had our IR staff. I said, look, just throw a bunch of companies out here. Let's take a look. and see how our strategy and what we do rates out. You know, we get that you're not going to have a lot of conventional presentations this week. You're not going to have a lot of offshore operations. What you see on the left is our EBITDA margins unhedged, you know, and so we're obviously, because we're oily, because we focus on putting new barrels through fixed cost infrastructure, this plays out pretty well. So you can see us in the top left quartile. Then on the right, and this didn't have a lot of colors in it, we basically said, look, where is our consensus 2021 EBITDA on a leverage stat ratio? And that's about 1.617. I thought that would screen out fairly well, so I put it on the chart, and I said, man, I'm only in the middle. I said, you know, add a little color to that. What in the world? Oh, yeah, the ex-bankrupt guys. Yeah, they're ahead of us. But if you take those guys out, we screen out pretty well. And I think that's part of the story when you look at who we are. We've never breached a financial covenant. We've never had to restructure our notes. We've been doing this 20 years. And I think we have a strategy that has been able to penetrate multiple commodity cycles. Again, EV per EBITDA, price per cash flow per share, all those things screen out pretty cheap for us. You know, why does offshore work? And it's interesting that, you know, I think the basin's been left for dead multiple times, yet it's still here, and you're still hearing about great discoveries. And I think there's some key attributes. It's an enormous, I don't know why that does that. I'm really not nearly attractive enough to be that big on the screen. It's a large geological column. It's an enormous resource base. It has ample infrastructure. We're trying to use that the best we can. That infrastructure leads to lower break-evens, and it's an emissions advantage barrel. Obviously, you hear some natural gas stories, and there's some emissions benefit to those stories. But on the oily side, deep water, Gulf of Mexico, emissions advantage barrels. And then the other part you see in the circle is because of seismic technology, because of computing speed, what you have is kind of a reinvention of these deeper geological plays as time goes on. And that's why you're hearing about more discoveries. You see Key Wells, Chevron's drilling, Shell's drilling, BP's drilling. Now you're seeing guys like us partner with those companies. And so much of what makes our strategy work is being a counterparty to the biggest companies in the world, whether that's an M&A counterparty or whether that's an exploration JV counterparty. And that's exactly what we're trying to do. And we had an announcement of the benefits of that in our Puma West discovery, which we'll talk about. So from an emissions advantage standpoint, so what we have here on the left is you can see deep water against other oily plays. And these are oily plays generally in North America. We could do another chart, what McKinsey has it out there if you haven't seen it, where you look at deep water against other jurisdictions around the globe that are oil weighted. In any chart, in any way you want to spin it, deep water Gulf of Mexico is an emissions advantage place. And we think that's very important for our story as we go forward. We also think the techniques that we aspire to as we lower our own emissions profile, which you see on the right, can be applied to the assets we buy. So again, what we're trying to show the majors is you are going to be judged by where these assets land as you pare down your portfolio. They can land in our shop, and we can take it from there. We're focused on it, and I think our team does a great job. And so what's the strategy? So you look at this, and this kind of gives you an overview of what the strategy looks like. So if we approach a company and we're buying blue, so we're buying the production curve, maybe a big NOC or an IOC or a major says, look, I think this asset has 4 years left, and then I'm worried about the abandonment obligations. We're going to go try to buy that thing at a fraction of those 4 years, let's say at 2 years. Then we're going to engage, and this is just a cartoon, but we're going to engage in these other aspects, asset management, infield drilling, exploitation. We can do something quick on the production engineering side. That 4 years becomes 5 years. We've bought ourselves a year. We engage in seismic reprocessing. That's when we start to look for things we can go drill, either from the facility or outboard 5 miles, 10 miles from the facility that can come back through that fixed cost structure and immediately raise the profile of that asset, lengthen the life of that asset as well. And that's really where the model works. And if you listen to our earnings calls and hear our announcements, most of the things we're talking about, most of the good news we have to share are typically extending the lives of our infrastructure and utilizing something that we probably bought at a low entry cost. So let's see how this works. This is in the Mississippi Canyon area. Here are a couple of facilities. And now, when we got into this, this was an area where we actually didn't have any assets. We entered through a merger with Stone Energy. It was actually the reverse merger that got us public. The Pompano is now one of our biggest assets. You can see an enormous acreage position covering a lot of geological plays that I'll get to in a minute. We can also use the spare capacity of that infrastructure to pull in third-party discoveries and get a piece of those discoveries as well just by hosting them. So in the last 2 years, there's been 2 discoveries that have come into our Pompano and our Ram Powell facility. And again, that's just easy revenue, offsets our operating cost, extends the life of the assets while we reinvest in these assets. We have a platform rig program that was just on our Green Canyon asset. It's now moving over to the Pompano asset. It'll be there for a couple years. We're excited about the quick turnaround projects on that facility. Here's Green Canyon. This is kind of BP country, and this is pretty interesting. So this shows you the strategy at work. So look at Green Canyon 18. There's a marker number 1. We bought that asset. It was only making about 1,000 barrels a day. We spent less than $15 million. It had a 25,000 barrel a day facility. Again, only making 1,000, 1,500 barrels a day. Engaged in a drilling program. Net to us, we increased another 8,000 barrels equivalent a day. It's got the highest production values it's seen in 20 years, and you can kind of assure yourself that now that the lifespan of that asset's increased another 5, 6, 7 years. That's exactly the redevelopment we want to do when we buy an asset. The Phoenix Complex was an old Chevron field. That's where you see the Helix Producer 1, which is one of the few floating production units in the Gulf. Bought that asset at 10,000 barrels a day, got it up to 43,000 barrels a day, and now we're in one of the first ever subsea intra-well water floods in that project. So again, buying with a low entry cost, reprocessing data in the area, redeveloping these assets using that fixed cost structure. Now, if you're lucky, when you do all this and you study the areas in which you enter, you might run into an evolving exploration play. And that's what we did in the southeastern corner in the Mad Dog area called Puma West. So what was Puma West? Well, that Mad Dog area is a 4 billion barrel in place asset for BP. It's well known. Folks who follow offshore know all about it. These wells can come online for 20, 25,000 barrels a day. That Argos is the second major facility BP has installed in that area. We knew the oil was spread out greater than what we could image seismically. There's a lot of salt dynamics that come in as you go to the west. We spent a lot of time on that. We built an acreage position around that, and then we permitted a well. I think within 6 hours of permitting that well, I got a call from BP that said, "Are you really going to drill that?" And we said, "Sure. We can pull some partners together. We'd love to drill this well." They said, "Look, we've got a rig, and we would like to move that rig right onto that location and drill that well." And that's the beauty of offshore. When you build enough of a position in the right play, the big boys will come to you. And you don't see that a lot sometimes in some of these onshore plays. So they came to us. We drilled the Discovery in the Middle Miocene under 11,000 feet of salt. We haven't been able to provide a ton of the details. I would say this did show up in the quarterly earnings report for BP. So if it's material enough for them, it's probably going to be fairly material to us. But again, more details will come out as we go. We brought in Chevron as a partner. So here's an example of our acreage position, starting around a simple enough transaction, building out from there, leading to a high impact discovery. That's the evolution of every transaction. Buy in at a relatively low cost, redevelop, explore. So what are the catalysts for the company? Well, look, doing more of that is certainly the catalyst for the company. Doing more of that in more areas. You know, is that the Gulf of Mexico? Is that going to be in the Atlantic margin? These assets are coming available, and we think they're going to be coming available at pretty surprising speeds in the next 3 to 5 to 7 years. And again, it's going to be about the counterparty. What's the financial health of the counterparty? What's the ESG track record of the counterparty? And we want to be that counterparty of choice. So we're going to be there looking for those. So again, more M&A, more exploration, and then we're going to expose ourselves in a very material way to what's happening in the low carbon economy. Again, we have homegrown an initiative that we started about a year ago that was focused on all the different ways we could transfer our skill set into these plays. We looked at everything. We think carbon capture along the Gulf Coast is exactly the place where we can do it. But to be credible, we wanted a partner. And just so happened, we were looking at a project in the North Sea called the Acorn Project, and it's going to be one of the largest FID CCS dedicated projects in the North Sea. And it was put together by a firm called Storegga. Storegga is run by a guy named Nick Cooper, who I've known for a long time. Nick's ex-Goldman Sachs. He was an ex-oil and gas executive. And so I called Nick and said, "Nick, we're working on this. We're putting it together. Do you want to expand that model to the U.S.? Because there's plenty of emissions along the Gulf Coast. It's the perfect place to sequester carbon." And he said, "Let's do it." So we announced a 50-50 JV with Storegga. This quickly, I should have jumped into this. On the catalyst side, 1.3 million acres, you have every play in your inventory. It's just a question of how do you put together the right play and the right capital allocation with the right risk. You know, if it's a low commodity year, we're going to focus on development and exploitation. If we can free up a little bit on the commodity price, we're going to introduce back, we're going to turn a little risk back on, and we're going to try to pull some of these plays forward, as you saw with Puma West. We're in every emerging play with acreage and facilities and partnerships that the Gulf of Mexico has to offer right now, and that's pretty exciting for us. Quickly on Zama, I jumped ahead. I'm going to get to CCS here in a second. Obviously, this isn't without its controversy. First of all, I think it speaks to our team. We were the first mover into the offshore Mexico space when they did the energy reforms. We made it I think everybody was waiting for Shell, waiting for the BPs and Exxons. We jumped in there quick, made an enormous discovery. We're having a little bit of a hiccup with the unitization discussions and the government of Mexico. That will play itself out. I think what we're trying to point we would make here is we have a discovery that one of our partners sold after the first discovery for $500 million with similar working interests. We've spent about $100 million to this point. There's going to be various ways we can monetize this asset. Right now, we're working with the government. We're going to continue to work with the government, but we're not short of options on an asset like this, and so I think we're in a great spot here. Again, global M&A I talked about. There's going to be a lot of sellers. We want to present ourselves as a buyer. So let's get into the carbon capture aspect of the story. So again, what skills do you need? We're not talking about direct air capture. We're not talking about EOR, so we're very clear about that. I'm not going to go buy an old EOR field in South Louisiana that's got 50, 60 wells somebody forgot to abandon. That's not what I'm interested in. We're talking about, and if we were doing this in a funny way, revisiting all the dry holes in my first 20 years, where I ran into a thick, saline, aqueous reservoir, and say, hey, can I inject carbon there? And the answer is you can. You have to understand it. You have to have a good idea of the geology and the geophysics, the logistics, the permitting, the operating. We've built our careers doing that. What we need is to develop the partnerships with the emitter, with the midstream. We have the contacts with the landowners. We know how the state works. A lot of this is in marshy lands and inland waters. So the Starega JV is perfect for us. It brings a credible partner. It brings a focus. It brings someone who's executing one of these projects in real time that can bring that advice to the table. We come in and we hustle on the logistics side, the land side, the business development side, and ultimately the project delivery side, which is exactly what we do every day in the Gulf Coast and the Gulf of Mexico. It's exactly what we've been doing in offshore Mexico, and we absolutely think we can do it here. It's an enormous market. There's room for more than one. And we certainly think we can go in there and pull this together pretty quickly. In fact, I think we're going to pull together a couple things in fairly short order. The level of emissions along the Gulf Coast and the access to the rock properties, and what you're looking for is you're looking for that really good conventional rock properties at a depth typically around 8,500 to 10,000 feet with wide geological structures where you can just put carbon away for 30 to 50 years. And you have that in these areas. I don't know if you have it yet in federal waters. The infrastructure is a little difficult. The permitting is obviously hard, either in federal or state waters, but you have ample place in the inland waters, inland private landowners, and state waters. And that's an area we're focused on from Corpus Christi through Alabama. We have a dedicated team working on this every day. We think it's an absolute makes sense add-on to our business, and we've got the right partner to do it with. And ultimately, it becomes something that when you put it together says, look, these guys are evolving from just oil and gas to energy solutions. And we think that's the evolution. If I have to think about what does the company need to look like 5, 10 years from now to be relevant, to cast a wide net of investor and investor demand, it just can't simply do oil and gas. Now, different companies that you're going to hear today have different skill sets in different geological regions, different geographical locations, and they can think about different ways to play into space. Responsibly resourced gas, maybe wind ownership, maybe geothermal, and we understand all that. For us and where we operate, to not distance ourselves from our skill set, this makes perfect sense for us, and we're going to go attack it, and we've got the full support of the board to do so. So quickly on guidance, look, we've been ahead, for the first half of the year. We got asked in the earnings call, are you going to adjust the guidance? We're into hurricane season, and I would tell you, the minute I suggested I'm not worried about hurricane season, I'm worried about hurricane season. So we're glad we had a strong first half of the year, well ahead of most of the points on this guidance. Our view as an offshore company is, take your blessings and hold it still, and let's see what happens during the months of September and October. Again, other key stats on the financing side. We spent some time at the end of the year last year, and look, we don't like the cost of capital, but we didn't want to wait for the market to be perfect. So we refinanced our high yield notes, did a little tack on. We did an RBL extension, and look, that isn't easy. Some of you guys follow the RBL market. That's not as robust a market as it was 5 years ago, 10 years ago. We got a nice extension, got the bank group down to 12 banks, and then in the last month, we added a 13th bank. So I think adding a senior secured lending bank in this environment isn't easy. We were able to do that. We were happy about that, and it speaks to their endorsement of our balance sheet. Again, $380 million of liquidity. We think that goes up at the end of the year Trailing 12 months, 2.2. If you look at our last quarter, annualized 1.8. Again, look at consensus EBITDA, that goes down a little bit, and a ton of asset coverage ratios. So, you know, we have a way that we finance these transactions, the way we negotiate the transactions, the trades we make to put the acreage together. You know, we have 800,000 acres of primary term acreage, and we spend less than 2% of our budget at lease sales. All that acreage comes through our M&A efforts, and we don't pay for any of it. You know, so that's the benefit of having not a lot of operators in a space where there's more sellers. You can cut pretty good deals, and ultimately that helps protect your balance sheet. So again, kind of the investment highlights for us. Again, a management track record that's done this for a long time. This is the third company I've been a part of building. Obviously, Talos has been around since 2012, 2013 on the private side, 2018 on the public side, and we've had a nice track record. And we're going to build on that. I think we're known as leaders from an independent company standpoint in the basins that we serve. It's oil-based, healthy margins, healthy credit. We have a good diverse opportunity of catalysts, both from the exploration side, and I showed you the map and the plays that we're in, and you're going to hear about more land trade in those plays soon. And then on the M&A side, I think we're a preferred buyer. So you should think about us as consolidating, exploring, and then diversifying into, again, low carbon opportunities through the CCS JV. So I think that's it. And then we're going to break out. If you haven't pulled the presentation and are interested, I would encourage you to pull it. There's some details on our mid-year reserves and how those move with oil prices, and I think that's important when you look about where we trade. There's going to be some other things on ESG that are worth looking at, and we actually take a little bit of a deeper dive into parts of the portfolio. So again, I would encourage you to pull the presentation. It's on there now, and then we'd love to hear from you in the breakout room. Thanks.